Think you've got the perfect investment portfolio? Think again. A well-built portfolio is only half the battle. Even the smartest investors stumble, not because of bad stocks, but because of bad habits. Welcome to the Simply Speaking About Money video channel. It is here where we talk about budgeting, saving, and investing in the real world of probabilities, and not the crazy hype, noise, and lottery-like promises of possibilities. Today, we're diving into the 7 asset allocation mistakes that will cost you years of financial growth. These aren't massive blunders, but small, insidious errors that slowly erode your returns over time. We've talked about what asset allocation is, how to build portfolios, and rebalancing. Now, let's make sure your hard work isn't undone by common pitfalls. Let's get into it. One of the biggest mistakes: overcomplicating your portfolio. Some people think more moving parts mean more sophistication, but often it just means more confusion. Too many funds, too many assets, and suddenly you don't even know what you own or why. This complexity leads to poor decision-making because you can't clearly see what's happening. The fix is simple: streamline. Keep your portfolio lean, with a few core, diversified investments that you truly understand. Next up, chasing performance. This is the financial equivalent of always looking for the next shiny object. You hear about a stock or sector that soared last year, so you jump in, only to find it's already peaked. This behavior often means buying high and selling low, a surefire way to lose money. Instead, focus on your long-term plan, not last quarter's headlines. Stick to your allocation, because yesterday's winners rarely predict tomorrow's. Then there's the cardinal sin of not rebalancing. You spent time carefully setting your asset allocation, but then you let it drift. As markets move, your percentages shift, meaning you might end up with too much risk without even realizing it. If your stocks have done great, they might now be a larger percentage of your portfolio than you intended. Rebalancing brings you back to your original, comfortable risk level. Make it a regular, scheduled event, not an afterthought. Copying someone else's portfolio is another trap. Your friend, your neighbor, that influencer online, they all have different lives, different incomes, and different risk tolerances. What works for them might be disastrous for you. Their aggressive growth strategy could give you sleepless nights, or their conservative approach might leave you far short of your goals. Build a portfolio that mirrors your unique financial situation and comfort level, not someone else's. Your financial journey is personal. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you. Being too aggressive or too conservative. This mistake is about misalignment between your actions and your true self. If you're overly aggressive, a market downturn could send you into a panic, forcing you to sell at the worst time. If you're too conservative, you might miss out on crucial growth needed to reach your goals. Finding that sweet spot where your portfolio aligns with your actual risk tolerance is key to long-term success. It's about balance, not extremism. Trying to optimize everything is a silent killer. This means constantly tinkering, tweaking, and trying to squeeze out every last fraction of a percentage point. This usually leads to excessive trading, higher fees, and often worse returns. Investing is not a video game where you can endlessly reset. Pick a strategy, trust the process, and let your investments do their work. Over-engagement often leads to underperformance because you're fighting against the market's natural cycles. Finally, reacting to news and market noise. The media thrives on sensationalism, making every market fluctuation sound like the end of the world or the dawn of a new era. Letting these headlines dictate your investment decisions is a recipe for disaster. Emotional decisions almost always lead to poor outcomes. Focus on your long-term plan and the fundamentals, not the daily drama. Tune out the noise and focus on what you can control. When you look at these 7 mistakes, you start to see a pattern emerging. They all stem from the same root causes: emotion and overthinking. It's not a lack of information that trips people up. In today's world, it's often an overload of information. We get paralyzed by choices or swayed by fear and greed. This isn't about being smarter, it's about being calmer and more disciplined. So, here's the golden rule for successful long-term investing. Pick a system that makes sense to you and aligns with your goals. Once you've chosen it, stick to it relentlessly, through thick and thin. Make rebalancing a non-negotiable part of your routine to keep your risk in check. Most importantly, ignore the market noise. Your financial future is built on probabilities, not possibilities, and certainly not on hype. Investing doesn't have to be complicated, and it certainly shouldn't be stressful. Simple, consistent actions beat complex emotional reactions every time. This has been part 5 in our asset allocation series. Once your budget is working and you've started investing, the next step is optimization. That's where Betterment comes in. Betterment is an automated investing platform that builds and manages a diversified portfolio for you. It handles rebalancing, tax-efficient strategies, and long-term planning, so you don't have to. You don't need to time the market. You don't need to pick stocks. You just need a strategy and consistency. If you're serious about growing wealth the smart, disciplined way, check out the link in the description to get started with Betterment. Affiliate disclosure: I may earn a commission if you sign up using my link at no extra cost to you. If you found value in today's video, make sure you hit the like button and subscribe to Simply Speaking About Money so you never miss practical strategies that help you build wealth and make smarter financial decisions. Also, check the description box below for the financial tool we recommend related to today's topic. It's a resource we personally suggest because it can help you apply what you've just learned and take action immediately. Your support helps this channel continue bringing you clear, no-hype financial education. Now stay with us, because up next is a special bonus that can help you take this even further.